Okay, marginal tax rate. So what we're talking about is what most people would refer to as your tax bracket. That's the rate at which your next dollar of income will be taxed. It's important because the because that's the rate that you want to use when you're making decisions related to taxes. So there's also what we refer to as average tax rate. The average tax rate is important, but it's not the one that you definitely want to use the marginal rate when you make your decisions related to income. So again, the marginal tax rate is the rate at which you could say your last dollar income is taxed or your next dollar income is taxed. So the tax rate schedules are indexed on an annual basis. So that's an effort by the IRS to avoid what is called bracket creep, which causes people to go from one income bracket to the next, and in order to so they're indexed in order to avoid inflation driving that. They want true increases in income. So this is an old tax rate schedule, I believe. This is actually the 2020. The next page is the 2022 tax rate schedule. So we've got married filing jointly and qualifying widowers, and then single. So there's also a head of household schedule as well. So, but the married filing jointly, the single. There's also married filing separately. For most part, married filing jointly and single covers most individuals. Typically the only case where you would file separately if you're married is that if you are separated. But I'm sure there are situations where that is not the case. But for instance, so if we go down here to your taxable income here, so if your taxable income is between $83,550 and $178,150, you're going to pay $9,615 plus 22% of the amount over $83,550. So, and we'll do some tax rate calculations separately, but if your income was between $178,150 and $340,100, you're going to pay $30,427 plus 24% of the amount over $178,150. So you'll note that the taxes are higher for single individuals, the breakpoints being lower, so that so marginal tax rate and financial decisions. I touched on this earlier. The decreasing your taxable income saves you money in taxes as your marginal tax rate goes up. Additional taxable income will cost you more in taxes because your marginal tax rate goes up. As we saw, go back to the schedule. These are the marginal tax rates. So if you're at 10%, if you're the first 22% in the first case between $83,550 and $178,150, then 24% if you're between $178,150 and $340,100. I guess I should say up to $340,100 be the correct way to say that. So the amount saved or added on your taxes is equal to your marginal tax rate multiplied by the amount that your taxable income goes up or down. So if you're able to, take a loss and reduce your taxable income, that in some instances you're able to deduct that from your taxes. So depending on the type of loss. Marginal versus average rates. So your effective marginal tax rate can be as high as 40% or more when state and local income taxes and Social Security taxes are included. Do an example shortly where we talk about somebody living in the city of Philadelphia, a single person where their tax rate is well over 40%, their marginal tax rate. Your average tax rate is lower. The average tax rate is your tax liability divided by your taxable income. So the proportion of the total income paid on income taxes. So different concept checks. Each chapter has these. So distinguish between a progressive tax and a regressive tax. So progressive tax burden over progressive tax increases as your income increases, and vice versa. Tax burden over regressive tax decreases as your income increases. So if you think about, sales tax is a regressive tax because somebody with lesser income probably spends all of their income in a given year. So somebody with greater income is going to be able to save and probably purchase things where they don't have to pay sales tax and so forth. What is a tax bracket or marginal tax rate? How does it affect taxpayers? The tax bracket or marginal tax rate is the rate at which your next dollar or last dollar of income will be taxed or was taxed. And this is the example I was mentioning. So why many taxpayers have a marginal tax rate as high as 40%. This is much more common in states where there is income tax. States like Pennsylvania, you pay state income tax and you also pay city income tax. So under the new tax law, a person in Philadelphia, Pennsylvania with $175,000 of taxable income would pay the 30 and be in the 32% federal tax bracket, pay 7.65 for their FICA, and then 3.07% for state tax and 3.97% for local tax. That total marginal tax rate of 46.69%. All right, so we'll start the next lecture on the 8 steps involved in calculating taxes. It is actually now the 7 steps.